So in this video, I'm going to share with you a common mistake that many traders make that is costing them profits.
Now, if you're looking for a retracement here, again, I would look for a retracement or relief to the base of the pattern, which is going to be right to here. That's not too far above the next inside level of structure as well. So you have your inside level of structure right here. You have the base of your pattern right here. So again, this is that first retracement of the pattern before we go up right here. I think this is a great level, 2644s, to look for a trading opportunity too. Now, question is, can you get that risk reward to work? That's going to be the hard part, because guess what? Let's say you're entering on a lower low, lower close. Where should your stops be? Well, probably above the high of this candle, right? Would you guys agree? If we bring in our Fibonacci, even if it's right there, even if we took, I think Francis had the 3 pip rule. Even if we take the 3 pip rule above the highs and we measure out to our projected target area, in order to get a 1-to-1, price action would need to close right above that line, which isn't going to give a lot of room. So risk reward may be an issue here on the 4-hour, unless you're shooting for a lower target area, right? Again, we can bring some volume on. And if you're shooting for, you can see a little bit of a spike right here. The bigger spikes are going to be down in our consolidative area. Again, rule of thumb, volume is always going to be higher in consolidative areas. So if you're good at identifying consolidative areas, you're going to be good at identifying volume. So if you're someone that has, a larger idea, you want to combine this volume with, say, a 618. So Fibonacci retracement, swing low to swing. Oh, sorry, I just put it on again. Sticky mouse. There we go. Fibonacci retracement, swing low to swing high. You want to add your 618 with volume and shoot for a lower level. I don't think we need to measure it out here, but you have plenty of room to get a risk reward 1-to-1. And yeah, this base would be a 382 as well. Now, the important thing is, here's what you don't want to do as a trader. You don't want to look at this and be like, well, I would shoot for targets here. Oh, but because I can't get a 618, because I can't get a 1-to-1 risk reward, now I'm going to shoot for targets here. And we see a lot of traders do that. A lot of traders work this thing backwards. And this is why we have a process, right? You guys know we are very process driven here at Tier 1. There is a process in which we go through things. Identify, predict, decide, execute, right? What do we do first? And you kind of can't do it backwards, but what do we do first? Do we measure our risk reward first, or do we make a prediction on where price is likely to go first? What would you guys say? We make the prediction on where price is likely to go first. That way we're not influenced, right? So I identify what's going on. I make my prediction of which direction I think the market's likely to go in. I make my prediction of, if we're going to go in that direction, where do I think we're likely to go to? I go down to my lower time frame and I get more detailed with that level, right? What I do is I say, I think price is going to go here. And once I've made that prediction, I'm not even thinking about my trade yet, but I think price is going to go here. Then I measure out my risk and I see what my profile is, right? I do that for a reason, because I want to be secure in my prediction. If we don't do it that way, then we're kind of forcing the trade to fit. Now we're saying like, okay, well, I got to get a 1-to-1 risk reward, so I'm just going to take a target here. And what happens is, now all of a sudden we're basing our trade. I'm taking my target here, not because I necessarily think price is going to go there for a target 1, but because it makes the risk reward fit, right? Does that make sense? Well, obviously, it doesn't make sense to do it, but does that make sense, the mistake that many traders are making? They're doing what they need to do to get themselves in the trade. Again, this follows up on the theme of the week, forcing trades. Then following up on the conversation we just had on the previous pair, price does this, then it does that, and you end up in a situation where you were right in your prediction, but you were wrong in your location. And yeah, it makes you feel good, but then you lost money. And at the end of the day, we got to make money in the market. So you don't want to force trades. You don't want to make something fit in order for you to do it. If it doesn't fit, you just wait for the next opportunity. Wait for the next opportunity. Maybe you get a second chance entry. Maybe you don't, and you just got to reanalyze another chart. Like the game of trading, unfortunately, it's not a lot of action. It's not casino bells and whistles. It is coming in every day. It is marking up your charts. And I would say that if you were to mark up 100 charts, you'll probably get about 50% of those charts that actually like follow through in your direction. And then out of those 50 charts that follow through in your direction, maybe like 25 will give you the risk reward that you require, the actual opportunity. And then out of those 25, maybe another half, maybe 12, 13 will actually give you a reason for entry. So out of those 100 charts that you mark up, you're probably taking like 15 out of the trades. But those are high quality trades. You're waiting for high quality trades. You're not just throwing money to throw money. This is your hard-earned money. You only want to involve it in the best opportunities, and that's what we're waiting for, the best opportunities. So patience is the key. Do not force it. That is the quickest way to give money back to the markets. When you give money back to the markets, now you're taking away from your wins. It defeats the purpose.
Hope you enjoyed. Don't forget to hit that subscribe button before you leave. And if you want more trading information, make sure you check me out on social media here in the short section in YouTube. Lots of daily trading tips. Also, check out the Trading Coach podcast, available 3 times a week on your favorite podcasting app.